Very good evening, all. Very good evening, all. I'm Professor Kausalya, and I'm happy to see you all in the other session of Bala's BB Academy. And today we are going to concentrate on the topics like cost and management accounting. So today also it's going to be a very informative and a very two-way communicative class. So try to cooperate with me when I ask any questions and give your answers in the chat box. If you have any queries also feel free to ask me during the class in the chat box. Okay, and let's begin the session. Let me share the screen. Thank you. Kindly confirm me, does the audio and the video is clear? I mean, I'm presenting a PPT. Does the audio and the screen is clear?
Yes, ma'am.
Yeah, thank you so much for the confirmation. Yeah, thank you, Sharmina. So let's begin. I would like to start with a quote. Once all villagers decided to pray for rain. On the day of prayer, all the people gathered, but only one boy came with an umbrella. That's faith. So faith has a big power, right? So I hope, and we're all affirmating that you're all going to clear UGC NET exam with JRF with that positive quote, energy. We are going to begin with the management account. So what is management accounting? According to you? So here it's all deals with the analyzing, interpreting, communicating information to the manager. So internally and the external part. So ultimately, it helps the manager to meet up the business goals. So here I have given a definition on it. And what about the cost accounting? So in the class, yesterday class itself, I've given the gist about it. So cost relating thing. So it determine how much money we need to spend on it, how much money the expense is going to be met. So details about all the goods and service cost relating matters. So it also involves of all like recording, classification, allocation of various expenditures, creating financial statements, and generally which will be used in the financial account. Here we have like different types of cost accounting. We are going to see like marginal costing, activity based costing, standard costing, process costing, all sort of things we are going to see now. What are the features of financial management accounting, my dear friends? What are the main features of management accounting? Here, management is not just like a science, right? So it's not just a rules, it's an art, like teaching. Management deals with all kinds of activity inside the organization as well as the outside the organization to meet up the goals. So management is maintaining a efficient activity. Also, it's a continuous process. Also, it achieves the predetermined objectives. Also, like systematic organized activities will be performed in the management activities. And we'll be aiming to the maximization of the profit and the betterment of decision making. Okay. What about moving to the first icon? Before moving to the financial statement, we'll have a small warm up on it. What would be the answer for this assertion reasoning regarding financial statement? Can you please tell the answer in the chat box? So in financial statement, so what is the answer, my dear friends? Yeah. If the financial statement contains some error and shall follow the ratios would also present enormous scenario. Of course, this is a correct statement. Accounting ratio exhibits relationship, if any, between accounting numbers extracted from the financial statements. The both the statement are correct. Whether we need to find out the correct explanation, we need to add one word between these two statements. The word is because. So if you connect it, it is coming as a correct explanation. We can go for the option one. Yes, absolutely. The option one is the correct answer because the financial statement, if it is containing any error, it is also going to be resulting in the ratio. And the relationship in the ratio, it's nothing but the numbers extracted from the financial statement. Obviously, both the statement is true and the correct explanation. Let me move on to the financial statement analysis, my dear friends. So here, in the financial statement analysis, here they will be working on to understand the financial position of the enterprises with the terms of analyzing the data and interpretation of the data, where the financial details will be classified into different forms. So why we need to have this financial analysis? So all these financial analysis will be enhancing the earning capacity or profitability. Earning capacity or profitability, and it also access the short-term and the long-term solvency of the enterprises. It facilitates the inter-firm comparison. It forecasts and prepare the budget to understand the complicated matters. So these are the main important significance of the financial statement analysis. So moving to the financial statement analysis, we are going to check out the ratio analysis. Let me reshare it, wait. So today we are going to move on to the ratio analysis. I'm just presenting the PowerPoint presentation. Here we have like types of analysis based on achieving the measurability of the profit by evaluating the operational efficiency to ensure the suitable liquidity and overall financial strength and the comparison. So to find out this, we are able to compare two ratio analysis, and we can find out these results with certain types. Let me explain it. So this is a ratio analysis thing. First one is liquidity ratio. So if it comes to liquidity ratio, the liquidity ratio which will be helping us to find out the company to take care of the short-term debts obligation. And also the higher the liquidity ratio, which will be representing the company which is higher in rich in cash. So here we have the formula. What would be the formula for current ratio? Current ratio is equal to current asset by current liabilities. Second one, quick ratio. So this current ratio, it's like a ratio between the current overall assets and the current liabilities, where it will be indicating the indicating whether the organization is being able to meet up in debts obligation in the upcoming 12 months. So within 1 year. Next one is quick ratio. So this is all about the ascertain information pertaining to capability of the company, whether they can pay off the current liabilities on an immediate basis. So in a very quick basis. For this, the formula is current, cash and cash equivalent. So for cash, we need to have cash, right? Next one is marketable securities. Next, accounts receivable, which has to be divided by current liabilities. So when we simplify it, we'll come to know about it. About the quick ratio. Moving to the profitability ratio. Here, the profitability ratio, which will be helping us to find out the earning sufficient profit by the company or not. So sufficient profit, did we bought or not? Next one, under this we have like 4 ratios. First one is gross profit ratio, which will be representing the operating profit of an organization after making any necessary adjustment pertaining to the cost of goods sold. Okay. What is the formula for gross profit ratio? Gross profit divided by net sales into 100. Next one. So net profit also can be determined for the overall profitability of the organization after reducing both the cash and the non-cash expenditures. So the formula is net profit divided by net sales into 100. Next one is operating profit ratio. So this operating profit ratio is determined to find out the soundness of the organization, and it's financially able to repay all the short-term and the long-term obligations. So short-term and the long-term debt obligation we'll find out from this. Okay. So what is the formula here? Operating profit ratio is equal to EBIT, earning before interest and tax, divided by net sales into 100. Next one is return on capital employed, ROCE. So this is a return on capital employed which will be used to determine the profitability of the organization in respect with the capital that is like invested by the business. In the business by the employer or the shareholder. So the formula for this ROCE is earning before interest and tax divided by capital employed. into 100. So these all will be in percentage. Okay. So not 100. Next one is solvency ratio. So solvency ratio deals with the whether the company is solvent or whether well capable of paying off its debt obligation or not. To find out this solvency ratio is find it out. So here we have like two ratios. One is debt equity ratio. Excuse me. Where the ratio between the total debt and the shareholder funds. So it's nothing but the total debts divided by the shareholder fund. So when we find out the ratios, we can calculate the leverage of the organization. An ideal debt equity ratio. What would be the ideal debt equity ratio? 2:1. Okay. Next one is interest coverage ratio. So here it is used to determine the solvency of the organization in the nearing time as well as how many times the profit earned by that very organization were capable of absorbing interest related to expenses. Okay. Here the formula is interest coverage ratio is EBIT, earning before interest and tax, divided by interest expenses. Okay. Next one is turnover ratio. So here this is like it is determined how efficiently the financial assets and the liabilities of an organization have been used for the purpose of generating revenues. So here the first fixed asset turnover ratio deals with the to determine the efficiency of the organization in utilizing its financial assets for the purpose of generating revenues. So fixed asset turnover ratio is formula is net sales divided by average fixed asset. Next, inventory turnover ratio. Here, it is used to determine the speed of the company in converting its inventories into sales. So the formula is the total cost of goods sold divided by average inventories. Next one, receivable turnover ratio. Here, it is used to determine the efficiency of the organization in collecting or realizing its accounts receivables. So the formula is net credit sales, which will be divided by average receivables. Last ratio, which is like earning ratio. In this, it is determined to find out the returns that an organization generates from its investors. Okay. So first, earning ratio. PE ratio indicates the profit earning capacity of the company. Okay. The formula is market price per share divided by earning per price. So market price per share divided by earning per share. Next one is earning per share. The formula, it is like earning per share is it signifies how the earnings of an equity holder based on each share. Okay. The formula is net income minus preferred dividend divided by weighted average of outstanding share. Okay. Okay, we'll see some Q&A now. Okay, try to solve this. Let me explain it. The sales value, they have given 4 lakh. Average stock value 55,000. Gross loss ratio 10%. Here the stock turnover ratio they are asked. So the formula for stock turnover ratio is equal to, as I said, inventory turnover ratio. Cost of goods sold divided by average stock. So average stock directly they have given already they have given 55,000. So the cost of goods sold formulas we know. To find out the cost of goods sold, it is the sales plus the gross loss. So how much how much money we have spent on the sale of goods, right? So cost of goods sold is equal to sales plus goods loss. So sales we know that 4 lakh plus 10% of the gross loss ratio. So out of sales, what is the percentage? 10%. If we calculate 10%, 4 lakh out of 10%, it's 40,000. So 40K. So 4 lakh 40,000 is your cost of goods divided by 55,000. Yeah. So 8 times 5 tables. 88 times, and this one 5 tables 11 times. So 8 is your answer. Option B. Okay. Okay, we'll see one more question. Okay, what is the answer for this?
Option D.
Yeah.
Option A, ma'am.
Kindly give your answer in the chat box. I want all of you to solve it so that everybody gets the chance of answering. Option D given by Shalini ma'am and Thirumagal ma'am is the correct answer. My dear friends, which of the following the debt receivables turnover ratio is correct? They're asking. So the ratio indicates the number of times of the receivables are the turned and converted into cash in an accounting period. Of course, it is correct. Those who said, yeah, it is a correct answer. But we need to check out the best answer, right? So the expresses, if it expresses the relationship between the total credit sales and the debtors. Of course, this as well. It also helps in working out the average collection period, of course. So option D is your answer. Next, we are going to move towards the fund flow analysis. So in this fund flow analysis, fund refers to what? Here, fund refers to the working capital. Okay. It is the movement and the changes. So every day we need some money to work on the organization, right? So fund flow analysis is a financial tool. It is like used to analyze the movements of fund. Here, that is called as working capital. And within a business or a specific period, okay? It highlights on two things, which is the sources and the application. Sources of fund and application of fund, where it will be helping the stakeholder to understand the financial resources which has been generated and used. So fund flow, usually it's calculated by, it is a difference between the sources and application of fund. So what are the sources? Sources means in what way the money came from. Application, in what way, how the money has been used. So ultimately, the objectives of this fund flow analysis is to analyze the changes in the working capital. Okay. Next, and to find out the major financial decisions, to find out the major financial health evaluation, and find out the evaluation through operational efficiency, financial planning, policy formation. For all these things, it is useful. Funds flow analysis is useful. Let's move on to the steps. How we need to find out the fund flow analysis is, first step is preparation of the schedules of changes in the working capital. Then we will be determining the fund from operation. So through this, we'll come to know the fund from operation. And we'll identify the sources and application of funds, and we'll find out the preparation of fund flow statement. Let's see one by one. There is a small simple rule for working on this changes in the statements of changes in the working capital. My dear friends, so as I already said, working capital is the daily day expenses met in an organization, so that we can able to prepare the current assets and the current liabilities. The rule is very simple. Current asset, if it is going to increase, working capital also will increase. Current asset, if it is decreasing, working capital will also decreases. If they are both friends, current assets. But current liability, it's an opposite reaction. If current asset increases, working capital will decrease. If current liability increases, working capital decreases. If current liability decreases, working capital will be increases. So it is an opposite reaction. So by applying this concept, we can able to find out the efficient increase or decrease in the working capital. So for that, the formula is very simple. Working capital formula is current assets minus current liabilities. So here I have given the statements of what and all things will be coming. So the current asset, we'll be having details. So we have like, we'll be comparing with the 2 years, the previous year and the current year. For example, if the current asset, cash in hand, okay, cash in hand of the previous year is 5,000 and the current year is 10,000 means it has been increased, right? From the previous year, current year, how much it's increasing? 5,000 is increasing. So, in the working capital, effect in working capital, I'll be mentioning in the increase column 5,000. For example, cash at bank, it's 15,000 in the previous year. And current year, it's going to be same 10,000. But here, see, previous year 15,000, current asset, it's been decreased 5,000. So minus, if you calculate the difference, it is coming as 5,000. So since it's a decrease, here also in working capital, it will be mentioned in the decreased 5,000. So same way you need to work on for the other bills receivable, sundry debtor, temporary investments, stock investments, and prepaid expenses, accrued income and all will be coming. So we'll find out the total current asset and moving to the current liabilities. So it's an opposite reaction, right? Here bills payable, sundry creditors, outstanding expenses, bank overdraft, short-term advances, dividend payable and all will be there. For example, if bills payable is 20,000. Okay. But in the current year, bills payable is 10,000. Okay. For bills payable, what happened? Previous year 20,000, current year 10,000. It has been decreased. So I'll be mentioning in the opposite increased column. So increased column, I'll be mentioning 10,000. For example, outstanding sundry creditors. Let me take sundry creditors. In the first year, it is 8,000. And the previous year. And in the current year, it's 13,000. So how much it has been increased? 5,000 it has been increased, right? So since it's an increase, I'll be mentioning in the decrease column. Okay. Similarly, we need to work on it for the working in challenge. Working changes in the working capital. When you find out the total of A and total of B, when you differentiate A and B, you will just check out the working capital. And for example, in this scenario, let me take like 5,000 plus 15,000, 20,000. And here also 20,000. Here it's 10,000. And here it's 23,000. In this example, okay, only I'm taking the first 2 items. I'll be differentiating 20,000 and 10,000. Here I'm getting 10,000. And here I'm getting a rough amount of 3,000. So the difference between this 10,000 and 3,000, what is the value? 7,000. Whether it will be a increasing column or decreasing column. It is a net decrease in working capital or increase in working capital. It has been what? Increased or decreased? It has been decreased. See? So in the previous year, it was 10,000, the working capital, but now it has been decreased to 3,000. So there is a differentiation between previous year and the current year. So this is a net decrease in the working capital. let me teach you one model sum here. See, my dear friends, here I have mentioned there are like share capital detail, profit and loss, debenture, trade and all given. But we need only what? Current assets, right? Current assets and current liabilities. So what and all are the current assets first? Stock in trade. So stock in trade, it has been increased or decreased? It has been decreased. Next, debtors will be taking. Cash will be taking in the current asset. And current liabilities, trade creditors, outstanding, and the creditors. Total creditors and the outstanding creditors. So you will be taking only these two. When you apply this in the column, I've mentioned all the items here. So previous year, so 2000 and 2002. So see in the first item, stock in trade 80,000 and 1,10,000. It has been increased. How much increase? 30,000. I am mentioning here. Similarly, debtor 36 to 30,000 decreased 6,000 here. Cash 4,000 and 5,000. It has been increased. So 10,000 here. So total current asset as a total of this is 120 and this is total of 1,45,000. Next total creditor, trade creditor 75,000 and 98,000. It has been increased. So the difference has to be in the decreased column 23,000. Outstanding expenses 5,000, 2,000. It has been decreased. So I'm mentioning in the increased column. So my dear friends, see, here the total current asset is 1,20,000 and total current liability is 80,000. The difference is 40,000. Similarly, for 2002, it's like 45,000. So here, my dear friends, 40,000 to 45,000. It has been increased, right? From 2001, it has been increased to 5,000. So this is how we need to find. So here if I go, it's like match thing. So this net increase in working capital will be going on to the next level for the sources of fund. So my dear friends, so this changes in the working capital will be helpful for finding out the statement of sources of fund. So sources of fund and application of fund. We have found the increase in working capital, right? So if it is an increase in working capital, we'll be mentioning in the application of fund. If it is in the decrease in the working capital, I'll be mentioning in the sources of fund. So let me tell you what and all are the application of funds, like what and all we'll be using. So we'll be using in trading loss, redemption of redeemables, preferential share, redemption of debentures, repayment of other long-term loans, purchases of fixed assets, non-trading expenditures and all we'll be doing. Similarly, for source of fund, it's trading profit, issue of share capital, issue of debentures, long-term borrowing, sale of fixed asset, non-trading incomes and all we'll be mentioning. So these are the inflow of money and this is the outflow of money. Okay. Let me give you one small sum here. My dear friends, here I mentioned the XY company. Here see they are given like assets and liabilities. So as we already seen one sum model in changes in working capital, we know what are all current asset and the current liabilities. Let me discuss about the preparation of fund flow statement. Okay, flow of fund analysis. So here working changes in the working capital, what are all items will be coming here? So stock, debtors, and cash at bank, right? So by adjusting this, we'll be finding out. Next one is current liabilities. We have like creditors. Then what else we need? That's it. So my dear friends, by taking these things into account, we have found that there is an increase in the increase in the working capital. As I already told, the net increase in the working capital will be coming in the application of fund, 10,000 I'm mentioning here. And apart from that, what and all items are there? See, I have just seen the land and building. Land and building, there is no change in the present year and the previous year. So no need. Plant and machinery, 24,000 and 34,000. So it is an addition of 10,000, which means what? There is a purchase of plant. How much? 10,000. That's what mentioned here. So purchase of plant. Next one is your capital. See, my dear friends, so capital here 80,000 to 85,000. So we have additionally issued a capital of 5,000. So issue of shares 5,000. Next one is borrowing of mortgage. My dear friends, in the first year, there is no mortgage. Second year, 5,000. So we have additionally borrowed 5,000. So mentioning here. And when you take a differentiation from this and thus fund flow analysis, the difference between the sources and application will be 10,000. And the funds from operation also will be finding out. Let me check. Let me tell you that as well. So the fund from analysis. So from operations are nothing but the adjusted profit, like net profit, non-cash expenses, non-operating income. So these combination, by adjusting all these things, like adjusting all these things, we'll find out the funds from operation. So that we'll find out the sum. Okay. So the total will be 20,000. Next, we are moving on to the cash flow statement. So cash flow statement, it is focusing on the inflows and the outflows of cash and cash equivalent. Okay. And here it is like it is also for a specific period. It provides a very clear picture of the company's liquidity, solvency, and ability to generate the cash to meet short-term obligations and fund operations. So why we need to find it is for the finding out the net movement of cash. There we found about the funds, right? But here we'll be checking out on the cash. So here the formula would be like to find out the cash flow very easy, as we discussed in the previous fund. It is also cash inflow minus cash outflow. So incoming and outgoing. When you differentiate, we'll just check out, we can find out the cash flow statement. Okay. And here the classification of cash is into 3 types. So cash is dealt into, one is operating activities, other one is investment activities, other one is financial activities. Let's discuss each by one by one. My dear friends, these are the format of details regarding the 3 types of activities coming under cash flow statement. So first one is operating activities. So here in the operating activities, we'll find out the details with regards with the cash receipts from the customer, cash payment to the supplier, and cash payment to the employees, cash payment for purchase or prepaid assets, interest payment, income tax payments, and other receipts and the payments. So that is mentioned over here, all kind of cash receipts and the debtors and all. Next one is cash from investing activities. So here it's the next step in building up the cash flow statement. It looks carefully on the company spent, which is on new capital investments. Like if a company capitalizing an investments, then that's outflow of money, right? Does not show up the income statement. And that's because of the accounting rules which will be applied to the depreciation expenses, the cost of the investment over time. So what are all items will be appearing here is the sale of fixed asset, short-term sale of long-term investments, interest received, dividend received, rent received, and purchases and all we need to subtract. And third one is financial activities. So coming to the financial activities, the final category of adjustments we need to address on the statement of cash flow analysis is money which has been raised by the financial activities. As in the case like cash from operations, we have to check out the both positive and the negative adjustment to find out the cash flow depending on the financial activities. So the items which appear here is proceeds from issue of shares, proceeds from issue of debentures and other long-term borrowing, repayment of debentures, other long-term borrowing, redemption of preference shares, interest paid, dividend paid and all. So as a combination of all these three activities, it is a net increase, net cash flow from all these things. We'll check out. So when as an addition, we have to mention here. And cash equivalent at the beginning, and cash at bank, marketable securities, short-term deposits, all will be considered as a value. So at the end, what is your overall cash will be calculated. Okay. Right, answer this in the chat box. Don't use your mic. I want all of you to answer it. If anybody have said the answer, others would hesitate to say the answer. Okay, try to answer the first one. Yeah, the first one answer is Thirumagal ma'am, Shalini ma'am, Nandini ma'am. Exactly. You are right. So cash flow example of an operating expenses is interest paid on term deposits by the bank. Good. So statement of cash flow clarifies cash flow according to what? Operating income, operating activities, investing activities, and financial activities. Try to answer this. Okay. So the answer for this, the purchase value of assets over its serviceable life is categorized as depreciation. A company that issues stocks and bonds to raise funds results into increase in the cash. Okay, moving to the process costing. So what is process costing? If you take a coconut oil, just like that, it does not come directly from coconut, right? It goes into several process to come into a product of coconut oil. So starting from raw material and moving on to the process of just clearing the things and taking out the copra out and crushing it, taking oil, filtering it, making the use of the scrap into other forms. And finally, the refined oil will be converting into a proper oil, going for checks, and finally the finished product comes into the market. Similarly, what and all cost has been involved in each of the costing. So for that calculation part, for that purpose, we are going to check out these process costing. So the process costing, it's like a branch of operational costing. And here, as I said, it is like determine the cost of product at each stage. And this is during the production or charged processes and averaged over the total units of manufactured. So we can able to find out the cost per unit by the ways like first in, first out method or average method or weighted average method. So what are the key features of it? So in process costing, we need to check out whether it's a continuous production or not. An homogeneous product. The output units has to be identical. And dividend into the processes has to be considered, and cost accumulation by process where the costs are collected for each process for a specific period need to be can be calculated. An average costing, the total cost for each process is divided by the number of units which has been processed to find out the cost per unit. So as I told you already, what is this first in, first out method? So here it separates the cost of the opening work in progress from the current production to give a more accurate cost per unit. Okay. And what is this average weighted method? In this, the average, the total cost and the total unit, including the operating work in progress, will be considered. And as the standard costing is like to determine the standard cost for the evaluation, the variance analysis. Okay? For example, let's assume that there is like for a process one, we need like 1,000 units started. Okay. We have started with 1,000 units. So, and material cost, material cost 20K and labor cost 10K, overheads cost 5K. And we think that normal loss. So this normal loss is what? It's the expected loss due to the nature of process. For example, evaporation and all. So the natural loss is considered as 5%, which is that is 50 unit. Units completed 950 units. So the total cost for incurred is what? So the total cost has to be considered by following the process. The step for following the process is, first we need to find out the cost center or process. Cost center or process. The second step is accumulating the cost by the process. Accumulating the cost, what and all are the cost involved. And third step is we need to find out the calculating the total and the unit cost. And the fourth step is accounts for normal and abnormal loss. As I said, normal loss is like an expected loss, like evaporation or not. Abnormal loss or gain is like unexpected loss or gain. So it is like treated as a separate cost, which is not included in the unit cost. Okay. And finally, transfer cost into the next process. So these are the process. Okay. As I given this sum, in this question, there are like 10, let's assume that we are processing first process, 1000 unit, material, labor, overheads, normal loss have been given, and units has been produced, completed is 950 units have been completed. We are just need to find out the total cost. So the total cost, what and all cost we can take? We can take the total cost of 20,000, material, labor 10,000, and overheads 5,000. So as a total, we'll come to know there is 35K. 35,000 is the total cost. And the unit produced, out of unit produced, how much we have unit produced? 950. So cost per unit is what? Cost per unit is 35,000 we have spent to produce 950. So what is the total? 35,000 divided by 950. So these units are to be transferred to the process 2 at this cost per unit. So what is the cost per unit? So 5 tables, 19 times 35, 7 times. So 700 divided by 90. When you calculate, what is the answer? So the answer is 36.8 exactly. So the first process, here is the answer. So similarly, this unit will be processed to the next. Okay. So these are the features which I already told you. Okay. Now it's 3:05. We'll have a small 5 minutes of break to relax our mind and calm ourselves, and we'll come back. We'll stay in the class itself. Okay. 5 minutes break. We'll have and we'll come back. Welcome back. Okay, my dear friends. Now we are going to move to the activity-based costing. So activity-based costing is, here it defines the various activities in the organization where like which has to be assigned cost to those activities, which is called as cost pool. So cost pool is the cost to those activities and then assigns those costs to produce or services based on the actual cost driver. So we have mentioned the cost, right? So we are just cross-checking with the cost drivers. So for in what way the costs are arising. Okay, that is all about activity based costing. In London they defines as CIMA defines that cost contribution to cost unit on the basis of benefits received from the indirect activities like ordering, setuping, assuring quality. Okay, so it is like a method to check out all those costs based on the activity or the task performed. So here the key activities are like, we know the activity means task. So what are the steps to find out the ABC? So let me teach you the step before moving to the example. See, the step is first we need to identify the activity where like machining or packaging or inspection and all. Second one is we have to find out the assigning the cost to the activity of the cost pools. So cost pools, I have already told the total cost accumulated for an activity. And the third step is identifying the cost drivers for the each activities. And third one is cost driver. Fourth one is calculating the cost drivers, rates. And finally, fifth one, we will be assigning the activity cost to produce the based on the usage. Activity cost will be there. So let me tell you one example. See, if they're like a product wise usage, there are like product A, product B. If product A setup is 20, sorry, if the product A is setup is like 60, we need to produce. And inspection 200 and unit has been produced is 6,000. Similarly, for setups, we are like having a product of 40. Am I audible? Does my screen is visible? Sorry for the inconvenience happened. Um, Technical issues. Okay. Let me repeat this ABC activity example once again. I hope my audio is and the audio is clear and the screen is visible. Yes, right? Clear, right? Confirm me, anybody? Clear? Yes, no. I'm just pressing. Yeah, thank you. Yeah, my dear friends. See, so here we have like two activities, as I said. The second B product, we have like for inspection, it considered as, let me consider 100 and unit has been produced is 4,000. So here we, as I told you already, we have to calculate the products based on the values which is going to be the cost which is going to be incurred. So here you can make a scope which soap A which requires more overheads means like testing and all. Then B, using activity based costing, you can assign the right overhead cost to the appropriate costing. This way your overheads is higher for soap A than B. So that you can equalize soap A and B and be more profitable on. Let's assume that the total cost for producing of A is 62,000. Okay. And for producing B is 38,000. Same product, but differing upon the packaging, quality and all. If it is differing, we'll be going for soap B with the better, with the less amount, but same usage and all other things. So that we can reduce the cost and maximizing the profit. There are like 3 levels as well. The level 1 is like finding out the different steps in the ABC analysis, like unit level, batch level, product sustaining the level, or facilitating the level, or like operational level. And the level 2 is identifying the main activities, as I said, like creation of pools or determining the drivers, cost drivers, and calculating it, and finally charging for the cost. So this is how we are going to implement. So I already told. Next, we are going to move towards the DO point analysis. What is this DO point analysis? Dew point analysis. So it's a component. My dear friends, it has been started during 1920 the management at Dew Point Corporation developed this model, okay, Dew Point analysis. So here, to assess the company's profitability. So this has been a tool which has been used to help us to avoid misleading conclusions, regardless the company's profits. For that, we found this Dew Point analysis. We'll be finding out the answer for getting out to break down the return on equities. So to check out the financial position frameworks and several key components to understand what is driving a company's return to the shareholders by analyzing the profitability, efficiency, and leverage. So we have a formula for Dew Point analysis return on equity. The formula is net profit into asset turnover into equity multiplier. So this is the formula for it. Where the net profit margin is the net income by sales, which is the net profit by sales, and asset turnover is the assets turnover is the sales divided by the assets, and the equity multiplier is the assets divided by shareholders equity, or the net profit or the profit after tax divided by shareholders equity. Okay, by finding out these things, we'll come out to check out the answer. Let me give you one small important example over here. So why we need to find out this Dew Point analysis? As I told you, it's a driving ROE, which is return on equity, and operational efficiency and financial structure we can compare, and we can also used by investors and analysis, and it is also used for the benchmarking as well. So what would be the limitations on it? So it is based on accounting data only. So it can be a manipulated one. And next one is, it does not consider any market condition or future potential. And also not helpful for companies with negative equity or losses. Okay. So let me give you one small example over here. My dear net aspirants, so let's assume that the companies has the following data, like net income 10,000, sales 1 lakh, total assets 50K, 50,000, and shareholders equity 25,000. Okay. So first we need to find out the calculating the components. As I said, there are like 3 components. First one is net profit margin. So net profit margin, so net income. So what was the net income? 10,000 divided by the sales, 1 lakh. So what is the answer? 10,000 divided by 1 lakh, 0.10. Next one is second component, asset turnover, which is sales divided by assets. So 1 lakh divided by 50K. What is the answer? 2. Third component, equity multiplier, assets divided by equity. So assets 50K divided by equity 25K. Again, half of it, right? 2. So the return on equity is equal to, we just need to multiply it. So 4 into 0 0.110, what is the answer? .4, which is 40%. Right? So 40%, there is the return on equity when we invest this activity. Clear? Next, moving to the cost sheet. So what and all items will be appearing in the cost sheet? My dear friends, it is a statement that shows the output of particular accounting period with some breakups of costs. So what and all other costs we are going to see? Through this, we can able to determine the total and the cost spent by the company, and for cost control and comparison. And it is also helpful in pricing distribution and decisions, and useful for identifying cost saving opportunities as well. So the first structure of a cost sheet, let's check on it. So these are the structure of it. So first we have to find out the prime cost. So the prime cost can be found by a combination of direct materials. So the direct material, direct labor, direct expenses, all will be coming under the prime cost. So the raw material opening, we need to add all the purchases of the raw material. Return outwards, we need to subtract any abnormal loss. And 1 minute. Or any raw material closing, we need to subtract. So next one is material consumed, direct wages, direct expenses, and direct carriage inwards, IR of special plant, chargeable expenses. By adding all these things, we'll come to and finding out the prime cost. Next one is indirect or factory expenses. So indirect costs is like indirect wages, factory expenses, factory rent or rates, or lighting, all relating to factory. Indirect material, repairs, depreciation on plant, loose tools and all. So as a total of it, we can subtract the sale of scraps from it, and we can add the opening work in progress and less the working progress in closing. So that we'll find out the factory cost or work cost or production cost, the other names for them. And the third is we are going to find out the office or and administration expenses overheads. Under this, the items are like office rent, taxes, office salary, lightings, insurance, and establishment charges, postage, repairs, legal expenses, audit fee, depreciation of furnitures, management expenses, cost of production. And we can add the finished goods in the opening, and we can separate the closing goods as usual. And we can able to find out the cost of production of goods sold. Okay, and finally we can add selling and distribution expenses, overheads, godown rent, storage, advertisement carriage outwards, selling expenses, commission, showroom rent, salesman salaries, collection charges, and all. So as a total of all these things, we'll come to find out the overall cost or cost of goods sold. And when you find out the difference between the cost of goods sold and the sales which has been made, profit can be identified by the balancing figure. Next one is marginal costing. So here the marginal costing is the incremental cost which arises due to the increase in one unit of production in the marginal cost, or it's a difference between the total cost of two different level of outputs. In generally, it's like an additional cost, my dear friends. Okay, so marginal cost per unit is equal to the variable cost per unit. It's an approach where units are always valued at variable cost or the marginal cost only. Let me tell you one example, my dear friends. So we have like, when we take like cost classification, we have two main costs, which is variable cost and fixed cost. The fixed cost won't be changing. It will be very fixed. For example, in a bakery, what are all, if a bakery shop, the what are all are the fixed costs? The chair, oven. Once we bought, it will be staying for all the thing, right? The box, all those things. But the variable cost, raw materials purchased for baking the cakes, right? Rent and all will be varies. So it is like monthly, it will vary based on the production we are going to produce. So the addition amount you are going to do for the next month, what is the value? That is called as the expenses net up meet is called as marginal cost. Let me explain. There are like first time I'm just creating one cell phone. Okay, for that I'm taking 10,000 as fixed cost and 5,000 per month as variable cost. So total cost spent for producing one phone is 15,000. But for the next time, fixed cost will be same, right? Once I bought like 10, all the fixed values, it will be fixed only. The basic equipments. And the variable cost to produce two phones is 10,000. So the total cost increase is 20,000. And the difference between the total cost for the additional unit is 5,000. So this 5,000 is called as marginal cost. Clear? Let me teach you the statement of uh, profit as per marginal cost. My dear friends, we are like, as I said in the cost sheet, there are like, we need to find out the direct and fixed values, fixed cost. So there will be revenue over there. And next we are going to find out the product cost, which is like direct material, direct employer, labor, expenses, variable manufacturing overheads. So as a total, we'll check out with the product invariable cost. Okay. Next one is the product contribution. Is the revenue minus this product cost. You'll find out the cost product contribution margin.
Then variable administration overheads and variable selling distribution overheads as a total. We can able to check out the contribution margin and period cost, which is like fixed manufacturing expenses and fixed non-manufacturing expenses. As a total of all these things, when you differentiate option C and D, you will find out whether it's a profit or loss based on the positive and negative value. Coming to a very simplified version of marginal costing, my dear friends, very simple. Sales minus variable cost, you will be getting the contribution. Minus fixed cost, you will be getting the profit. There are some formulas to be implemented for finding out the contribution, which is say contribution is equal to sales minus variable cost. To find out the profit, I told now profit minus fixed cost. To find out the profit volume ratio, there are like two formulas: contribution by sales into 100 or change in the profit divided by change in the sales into 100. And break even point. Break even point is the point where there is like no profit or loss. So here the formula is fixed cost divided by profit volume ratio. And break-even point, if you want to find it in the units, the fixed cost divided by contribution per unit. Okay. Next one is margin of safety. For margin of safety, the formula is sales minus break-even point, or else profit divided by profit volume ratio. And the sales at desired profit. To find out this, fixed cost plus desired profit divided by profit volume ratio. Sales at desired profit in units means fixed cost plus desired profit divided by contribution. So if time permit, at last we'll just try to solve sums on it. I'll teach you few sums on this now. So here I've given the features. My dear friends, assume that in the company, a company is selling a product of 50 per unit, okay? In this 50 per unit, the variable cost is 30 per unit, okay? So the fixed cost they have given 40,000. And the company is selling 3,000 units in a month. Okay. So now we are going to calculate the contribution per unit. So what is the formula for contribution per unit? So contribution per unit is equal to selling per unit minus variable. So contribution is nothing but sales minus variables, right? So selling per unit is 30 per unit or 50 per unit. So this is variable cost, right? So selling per unit. So selling per unit is 50 and variable cost per unit is 30. So contribution is 30 per unit. Sorry, 20 per unit. When you subtract it, you will get an answer of 20. Okay, 20 rupees. Next one is total contribution, what is the value? We found that there is like how much value we have invested, 20 rupees per unit, right? The total sales we are making for 3000 unit. So for 3000 into 20, what is the value? 60,000 we are spending as contribution. So find out the profit for this. So profit is equal to contribution, total contribution minus fixed cost. So we found that the contribution is 60K and fixed cost is 40K. So what is the profit over here? Rupees 20,000. Okay. So here, what is the break-even point? In units. So break-even point in units is equal to fixed cost divided by contribution per unit. So fixed cost is what? 40K. Contribution per unit we found. It is 20 here. So when you divide, what is the answer? What is the break-even point per unit? 2000. So when you sell 2000 units, there comes there no profit or no loss. So for minimum, we need to sell at least 2000. So more than 2000 when we sell, we'll meet up with the profits. Clear? Okay. Next, we are going to move towards the cost volume profit. So what is this cost volume profit? So cost volume profit analysis is like analyzing these three factors: the cost, expenses made, and the volume, and the profit which has been incurred from it. So also it is called as break-even analysis. So break-even analysis is like companies to determine how changes in the cost, both the variable cost as well as the fixed cost. Both affects the sales volume, which affects the company for profit. With this information, the companies can better understand the overall performance by looking at how many units must be sold to break even or to reach a certain profit, or to meet up the safety margin of safety. Okay. Here the main components which I already said in the marginal costing. So here all the marginal costing equation, contribution margin, profit volume ratio, break-even analysis, margin of safety, all will be common over here. So here I've given the several assumptions to be made under in performing the break-even analysis. Sales price should be constant, variable cost per unit constant, fixed cost constant. Every product should be sold, should not be backed up, and the costs are only affected because of activity changes. And if company sells more than one product, they are all sold at the same mix. One minute. Okay. So under this, I already told it is going to study about the changes, how it is made in the cost and the volume, which is going to affect the profit. Let's check on with the margin of safety. Okay. So what is the formula for margin of safety? As I said, margin of safety is equal to actual sales made minus break-even sales. Okay, let me give one sum now. So here, my dear friends, assume that there are like actual sales made is 3,000. And break-even sales. Break-even sales, instead of sales units, they have given 2,000 units. Okay. Selling price 100. So how you found this? How can you find this margin of safety? So actual sales, we can directly take up 3,000. Break-even sales in rupees. So here we just need to multiply the break-even sales 2,000 into the selling price 100. So when you multiply this 2,000 into 100, here comes the answer as actual sales is 3,000 into 100. We'll come to get an answer of 3 lakh and break-even sales 20,000. Sorry, 2,000 into 100, 2 lakh. So, margin of safety, you get an answer of 1 lakh as an answer. Clear? Next, moving to standard costing. What is standard costing? So we will have a benchmarking, right? Already, if we already spent some amount on the previous historical way, we already know there is like some expenses to be met, and checking out with the previous historical cost, what is the things which has been made. So in the standard costing, so it is a costing accounting technique where like preferred standard costing is compared with the actual cost. So this is nothing but predetermined standard cost. So already we know that maybe like 100 rupees was going to be spent. But in certain time, the actual cost for producing one unit, it costs like rupees 120 rupees. Standard cost we fixed as 100, and but actual cost it made like 120. So this 20 rupees, right? This 20 is called as variance. So the difference between the both standard and the actual cost. So we are going to analyze why this difference has been made. By analyzing this, we can able to check out the cost control, performance evaluation, decision making and all. And why we need to find out the standard costing means to set up the benchmarking. and control and reduce cost, to evaluate an efficiency performance, to assets in budgeting and decision making. So as I already told, there are like mainly two components, which is like standard costing and actual costing. Difference is variance. This may be in two forms. In this scenario, it's a year, the actual cost is higher than the standard costing. So we have like, when the actual cost is more than the standard cost, it is unfavorable variance. If it is favorable, in the scenario, actual cost is greater, right? So this 20 belongs to unfavorable variance. For example, same under standard cost, 60 rupees only the actual cost has made. So it is like in a positive way. So this 40 will be a favorable variable. Okay. So here also we have like types of variances. So first one is material variance. And labor variance. My dear friends, there are three types of variances apart from this positive negative thing. So first one is material variance. So the material variance tells out the standard pricing and the standard quantity minus actual price and actual quantity. So this is the formula for it. So the standard prices, like they will be multiplying with the quality, the quantity and the price. If it is a labor cost variances, it will be mentioned as standard rate into standard hours. If it is like labor cost variances, standard rate into standard hour, same, minus actual rate into actual hour. The labor, how much the person is going to be. If it is like overhead variance, it is based on the standard actual as absorption of overheads. Let's see one example. So these are the features which I already told you. My dear friends, check out. Let's consider that the material cost variance, okay? So material cost variance. So they have given standard quantity is equal to 10 kg per unit. And standard price is 5 per kg. Actual quantity used 110 kg for 10 kg for 10 units. Actual price we sold for 6 per kg. Find out the marginal cost variance. So what is the marginal cost variance? I already said marginal cost variance is nothing but the standard price and the standard quantity. We just need to multiply and we need to subtract with the actual quantity and the actual price. So standard quantity for 10 unit is equal to 10 unit means 10 unit into 10 kg. They are given for 10 unit, right? Actual price we just need to find out for this particular 10 unit. So 10 units means 10 unit I'm just checking for 10 units. So standard quantity 10 units into 10 kg we'll find with 100 kgs and standard cost price is 100 kg into 5. Standard price is 5, right? So 500. When you multiply this, next actual cost. Actual cost is 110, right? Into how much rupees we sold? 6 rupees. So 610. Sorry, 660. So the difference between 500 and 610. What is the answer? We got a positive answer only because the standard cost is 500. But sorry, the exact amount is more than the standard cost, which is unfavorable. What is the value? 160 rupees, which is our answer, which means 160 more than the expected due to excess usage and higher price. Okay. Clear as of now, my dear friends, net aspirants? Okay, it's been 4 o'clock. We'll just take 1 hour has been done. 5 minutes we can relax ourselves and we'll come back. Okay, we can be in the class itself. We'll continue with some more topics and we'll solve some MCQs if I finish earlier. Okay, I'm planning accordingly. Try to come. Okay, my dear friends, coming back, welcome. I hope my audio on the screen is visible. Now moving to other types. Life cycle costing. Sure. My dear friends, the life cycle costing tells about the it's a like a method of assessing the total cost of the ownership over the life of an asset or the product or the project. It will be including all the costs and from acquisition to the disposal. At the time of purchase and to get rid of it. Okay. Next one is, it's not just an initial purchase or production cost. It's like a widely used in the project management. And it's also used for capital budgeting, product pricing, long-term investment decisions and all. And the stages involved in the product life cycle is first stage is research and development. Next stage is designing and engineering. And then we'll be going for the production and manufacturing. And next, operation, uses of it, and maintenance. And finally, we'll go for the disposal or the retirement of the product or service. So we have like list of cost used in the life cycle costing. First cost category. Acquisition cost. So acquisition cost is the cost where we'll purchase price, right? Transportation, installation and all. Next one is operational cost. So to use towards it, like power, fuel, labor, raw material and all. Next, maintenance cost, where like repairs, services, parts replacement, interest, leasing, insurance and all will be coming. Next one is financing cost, where like interest, leasing, insurance and all will be done. Disposal cost. So your discommissioning, scrap handling and all will be there. Finally, environmental cost. Here like waste management compliance will be under the way. Okay. So why this life cycle costing is important, because it is going to be help for the long term application, for long term planning and all, capital investment decision, product pricing, cost efficiency. It is like going to be sustainable procurement. So it's applicable for all the construction and infrastructure products, energy, utility planning, vehicle fleet management, product designing and pricing, public procurement and tender. So what would be the limitations of it? We need to require accurate forecasting on it. We can be a very data intensive, and it is very hard to predict the future maintenance and disposal cost as well, right? And by comparing like inflation, interest rate can also be a distort long-term figures. Next one is, for example, we'll be considering all the cost and we'll get for the total 5 year, okay? Just moving to the just in time, JIT. So just in time, it's a inventory management and production strategy. Okay. So here they aims to reduce the inventory cost by receiving goods only as they needed in the production. So not like just keeping it in their hands and for storing it and all. It's no matter there. They focused on zero inventory, zero lead time, zero failure leads to just in time. So clear production. What is need fitting towards it. So here the goal is to improve the efficiency, reduce the waste towards it, and to ensure the products are available exactly when they need it. So they relies on pull system. So pull system, push system is there, right? Two system. Pull system is uh, pull system is customer will wait for the product to launch in the market. So, but push system is the manufacturing unit will be pushing towards the customer by giving discounts or bulk orders and all. For example, if the next iPhone is going to be launched, so the customers will be waiting to purchase it. So that is called as pull system. So they just in time also give importance to this pull system. Okay, to by it is like a customer focusing by the customer demand rather than forecasting towards it. Next one is minimizing inventories are the principle. Streamlining the production, we can increase the efficiency, and we can also know about what customer needs and wants, and supplier relationship will be there, and here the production will be produced only at the rate of the customer want, and they ultimately do what the current society needs, and they keep on have a kaizen. What is kaizen? Kaizen is continuous improvement. So they focus on constant improvement to eliminate the inefficiency and improve processes. Okay. Next one is the benefits and the advantage and disadvantages are like they reduce the cost, less investments will be there, they speed up the manufacturing, eliminates the lead time, short time runs will be there. And moving to the disadvantages, they lead to potential supply chain distraction, and no margin will be to make errors, right? Unable to meet up any unexpected order from customers, and no time for renegation with customers. And risk of shortage, the coordination may be a problematic one. And some examples of just-in-time action is like production plan, inventory level, suppliers, impact towards it, and all. So real-time example, Toyota. So Toyota the JIT was originally developed and perfected by Toyota during 1970s. Okay, this Toyota famous production system is based on the just-in-time principle. Okay, so this is very important. Next example is Dell. So the computer manufacturing uses just-in-time to reduce the inventory cost and assemble computer only when orders are placed. McDonald's. So McDonald's are like is a fast food giant uses, right? They also uses just in time in its kitchen to ensure ingredients are very fresh and minimizing the waste. Next one is
Kaizen. Target costing. So what is this target costing? So here it is a pricing strategy, my dear friends, in which a company determines the desired profit margin for the product and then works backward to calculate the target cost of producing that product. So it's a kind of a reverse process. Okay, so the total cost is calculated by the selling price minus profit margin. So here it's an approach that ensures that the product is priced completely while still meeting the profit goals. So let's discuss about the steps. So steps is, first they will determine the target selling price. Next, they will determine the desired profit. Next, they'll calculate the target cost. And finally, they will be going to analyze and control of cost. Okay. So what are the advantages of it? We'll have a better cost control, competitive pricing will be there, profit maximization we can increase, continuous improvement we can make. Disadvantages of target costing are like pressuring on cost reduction, and complex models are there, and they will focus on cost over innovation. Okay. For example, the target costing when we need to find for the selling price of 25,000. The profit margin is 5,000. So what would be the exact value of the total costing? It's 20,000. So if it is going to be a conflicted one, like meeting up the profit and the desired profit, if there is a fall down of it, so the expected market price, it's going to be not meeting up with the actual price which we have created. Here comes the required cost reduction and the finding out the future whether we are going to meet up the profit or loss, or at least in the break-even point. So these are the steps which we have discussed. Next one is Kaizen costing. So I already said the meaning of Kaizen, right? So what is Kaizen costing? So it's a cost reduction system, okay, that focuses on continuous and small incremental improvement to reduce the cost during the production phase of the product life cycle. So continuous improvement is the key word. So unlike the target costing, they will be focusing on the designing phase, like which before the product is launched. But this Kaizen costing is used after the product is already in production, even in the production. So the key features are like cost reduction, relies on small and ongoing improvement, and they also encourage employee involvement, continuous improvements in the process, material waste management, and does not compromise product quality or customer satisfaction. So here, the steps to be involved is setting up. One minute. So it is also a Japanese business philosophy for continuous improvement. So your high means changes or action to correct. Zen means good for the better information. So it there is like with the principles, continuous improvement, all the participants, employees has to participate, and they also has like no limit to the improvement level. So there are like two types of Kaizen costing. One is asset specific, which is like Kaizen costing activities are planned and directed as per the requirement of the firm or the deal on based on the assets. Product oriented is like they will be undertaking specialized projects with a great focus on value analysis. So these are the 5S: sort, straighten, shine, standardize, and sustain. So this is the process where I coming to say, like we need to involve the employees in it and finding the problem, thinking the solution of it, implementing and checking towards it and standardizing and repeating the first one. So here, when we involve employees, they they will have a good bond towards the organizations, right? So these are the advantages of Kaizen costing. They will have a better satisfaction, customer satisfaction, employee satisfaction will be there. For forming a work team can be built for better future. Continuous improvement will be made. Problem solving. And also they promote cross-functional teams. If one person is good in one area, by giving proper training in the other field, he or she can train and be efficient in any areas in the organization. Next, it also widely applicable nationally and internationally. And finally, it reduces waste, which is the ultimate progress of it. So the disadvantages may be like it may be a burden on lower level management, and it also when they lack of training, if they give any ideas and implementations, it's going to be a problem for the company, and permanent change will be there, repetitive change. So to adapt towards the situation, it will be a harder task. Next one, we are moving to the budgeting. So budgeting, it's like a tool which has been used for the planning, programming, and controlling of the business activity, right? So ultimately, financial in a very quantitative statements. So they provide like statements, policies for the particular period to attain the objective of maintaining the profit and all. So it also includes the income, expenditure, and employment of the capital. So moving to the budgetary control. Here, it's not only about planning and controlling. It is having a wider aspects to show the plans in financial terms, having an advancement in the various functions of the business so that they can have a efficient research towards it. So it's like managing income and expenditure in common, of course. Managing the income and expenditure through the preparation of the budgets, like comparing with the actual results, actual costs which happened in the previous years. And here, like variance analysis and all we studied now, standard costing, actual performance, these and all are analyzed and corrective actions will be implemented. So why we need the objectives of budgetary control is to plan for the future income and expenditure, to coordinate the activities of different departments, to control cost and improvement efficiency, to fix the responsibilities and promote the accountability, to assist in decision making and performance evaluation. So we have like different types of budgets as well, like operation budgets, day-to-day expenses will be made. And cash budget. So cash inflow and outflow, cash flow statement, right? Next one is capital budget, where there will be like planned investments for the long term. Flexible budget, where like adjustment will be made based on the actual activities level. Master budget, where a complete set of financial plans for the organization. So what are the process? We'll be preparing the budget, approval implementation will be there, and monitoring actual performance and the various analysis and corrective measurements will be involved. So for the disadvantages of budgetary control, it is based on the estimations only. And this may make departments might stick into the budget blindly. There will be a rigidity here, and they may create the conflict between the unrealistic and unfair goals, and time consuming to prepare and maintain. Some may discourage innovation if employees fear going beyond the budgets. So these are the objectives. So they will harmonize the departmental programs. So they can broke down into sizes and styles. They can decide for the basis of expenditure of funds and all. So as I explained you. Next, we are moving to the zero-based budgeting. So zero-based budgeting, ZBB. It's a budgeting method where every expenses must be justified for each new period. So every expenses must be need an explanation and justified. So it's like starts from the zero. Okay. Instead of like using the previous year budget as a starting point, no traditional budgeting and all. So every year there will be a fresh start. All the functions within an organization are analyzed for their needs and the cost. And here during the late 1970, USA was facing great financial crisis. So there was like high rate of crisis. At that time, in order to control the deficit, in 1977, zero-based budgeting was introduced. So here they allocate resources to depends on the basis of debts, justifying their expenditure. Allocation to administrative ministry starts from the zero basis.
So the advantages are like they reduce expenditure, eliminates low priority programs, ensuring like high impact programs to get more revenue. Okay, and cost efficiency, strategic goals. What are the negative points? The negative disadvantage points are like time consuming. It can be complex for larger organization, risk for short-term focuses on cutting useful but non-immediate impact activities. Departments may feel pressure to defend for their existence. It is like a need based on time, discipline, and top management support. It can be very successful. The next one is target-based budgeting. So what is this target-based budgeting is? It's an approach where each department or unit is given for predetermined financial target. As like costing. Okay. In 1980s, US President Ronald Reagan introduced this. So they adopted this neo-right philosophy where the role of state was drastically reduced. So they started to give more importance to focus on market, achieving the objectivity of growth and development. Okay. So they fairly been successful during those time. So why can't we implement in other organizations as well? So budgeting targets in advance, like reducing like spending by 10%, or departments must allocate resources and adjust plans to meet those targets, and focusing on financial disciplines and cost controls and efficiency. Often they use in both private sector and government budgets. In how it's work, like management sets like financial target, like example, they cut 15% from the last year budgeting and all. Cost cutting methods. Yeah. So what are the advantages of it? It also encourages cost saving and resource optimization. Simplifies budgeting by giving clear guidelines. And also it easier to implement in the zero-based budgeting as well. Provides discipline framework for departments. Yeah. What about the disadvantages side? So it may lead to cut without understanding actual needs. Arbitrary cuts will be there. And it also can discourage innovation in the departments. It may result in underfunding essential services. Lack of flexibility will be there if circumstance changes during the year. So there are also some gender budgeting, green budgeting are there. Gender budgeting, new performance budgeting in recent time, 2010, new techniques of the budgeting suggested by the IMF. International Monetary Fund. So here it's a combination of old performance budgeting and planning for the programming for the future budgeting as well. Gender budgeting deals with the objective for women empowerment. And there won't be any clear specific amount allocated to the women relating to the schemes and all.
green budgeting, eco-friendly budgeting, where in the LPG era, there were like phenomenal climate changes and all seen over all the world, right? To develop those activities. And also believe that 1% increase in the GDP takes place with an impact of ecological systems by reducing the environmental pollution, ensuring the sustainable developments and all. Outcome budget was introduced during 2004. And they adopted the right-based approach to develop. So here, that links with the money spent by the government to the result of outcome achieved. So money has been implemented. So as a result of it, how much achievements have been made? It's completely based on the evidence-based policy making. So budgetary control, I already told you. So these are the budgetary control process, planning the budgets, comparing it, variance action, the advantage, disadvantages also I have just discussed in the previous slide. Where the through all those budgets will ultimately focus on maximization the process of profit maximization and improving the coordination among the people and provide specific aims towards it and tools for measuring the performance, corrective actions, reducing the cost and all, and determining the weakness and improving on it. Disadvantages, like uncertain is future, right? So based on it, we cannot predict all the thing which is going to happen. For example, the corona, which has happened in the past, conflict, depends upon the support. So in this material PPT, I would like to share some more points also while sharing to sir. And now I have covered maximum in respect with the UGC NET exam aspect. So let's see some Q&A now. Okay. Let me share. Wait. Okay, try to answer, solve it. Tell me in the chat box. The expenditure is called as capital expenditure when?
Ma'am, my chat box is not enabled, ma'am. It is going to
One
someone
minute,
else,
let me
ma'am.
check. Okay, what is the answer? Can you able to check it now? You're not able to type?
No, ma'am, it is going to one of the participant as a host, ma'am, not to you,
Okay,
ma'am.
no problem. We'll have a quiz then. Okay? I'll be noting down your marks, scores. Let's play a quiz, okay? Okay. Let me show now. So here there are like Shalini ma'am, Thirumagal ma'am, Gauri ma'am, Indra ma'am, and Suganya ma'am, Safia ma'am, and Nandini ma'am. Okay. So say your answer, okay? You can unmute and say your answer. The correct
Option D. D, ma'am.
Yeah, who said the answer? Yes, my dear friends. So let me ask at last, okay? The expenditure is called as capital expenditure when it is intended when it is intended to be benefited in the future period. Correct, okay? What about revenue expenditure? So these are like which has been incurred in the day-to-day business. One minute, I'll reshut. So get your point, okay, ma'am? Those who said the answer at last, I'll ask. Okay, try to answer this.
All the above, ma'am.
Yeah, option D is your answer. So capital budgeting, appraisal method, all these things will be there. Next.
Payback.
Yeah, the term payback, payout, payoff, all refers to the period in which the project will be generating the necessary cash to recoup with the initial investments. So all these things. So here, if required, if the project required 50,000 in the initial investment, it is like it will generate an actual cash flow of 10,000 in 6 years. The payback period is what?
5 years.
5 years. So here, in other 5 years, we can able to get back the money. So 10,000 we are going to get means for getting 50,000 we need 5 years. Okay. Try to solve this one. Here it's a sum for payback. That's why I'm mentioning here. So payback is like an year budgeting sums I thought of sharing you. My dear friends, in this is sum. In the project required initial investment 20,000. Okay. And the annual cash flow is 5 years for are like 6,000, 8,000, 5, 4,000, 3,000 respectively. In how many years they're asking like what would be my payback period? Let me teach you this model. See, a year I mentioned the cash flows and cumulative cash flow. For the first year, I'll be getting 6,000. In the second year, 8,000 I'll be getting, right? So 6,000 plus 8,000, I may get a value of 14,000. Next year, 5,000. So 19,000, similarly 23,000 and 26,000 all together, all this year. So the payback period is how much year they have given. In the cash flow of 5 years, they're asking, right? So the payback period is from 3 years plus 1,000 by 4,000. There is a mistake over here. Okay, wait, let me check on it. Meanwhile, you try to solve the next sum. Wait. One minute. Okay, can you able to see the sum? Try to solve it. It tells about to find out the fixed cost, variable cost, selling price, and output level they have given. The profit during the year they have given. We need to find it. So what is the formula for profit? So your profit is equal to sales minus variable cost minus you will get a contribution minus fixed cost. Just find out and tell the answer. This is the flow. Okay. Check. Which one? My dear friends, so what is the answer?
25,000, ma'am.
Yeah. 25,000 is your right answer. Why? Because, see, the sales value is 15,000, right? Yeah. Into 15 rupees selling price, 2,25,000. Variable cost is 15,000 into 10 rupees variable cost price. So 1,50,000. So when you add, when you subtract it, you will get an contribution of 75,000 and the fixed cost is 50,000. So 25,000 is your profit. Clear? So as I said in the previous question, sorry for the inconvenience happened. It's very, very simple, my dear friends. So here we need what for initial investment is 20,000, right? So yearly they are getting a income of like profit of 6,000, 8,000 and all. They're asking like, in how many years I'll be getting back this 20,000, right? So in the first year, 6,000, second year, 14,000, third year, 19,000 I'm getting. And to reach the 20,000, I need what? 1,000 rupees I need, right? So in the next cash flow, out of 4,000, I need only 1,000. In how many days I'll be getting that 1,000 I need? So that's why in the first 3 years, I will be getting this 19,000. That's why I'm mentioning 3 years. And I want 1,000 from this 4,000. So 1,000 divided by 4,000. So 3 years plus 1 by 4. So 1 by 4 is like 0.25, right? So 3.25 years, I'll be getting my answer. I'll be getting my value. Got it?
Yes, ma'am.
Yeah, very simple. Okay, let's solve some more sum. Okay, try to solve this one. To find out the break-even point, the formula is fixed cost divided by contribution per unit. In unit. Then you need to multiply with the selling price unit. So fixed cost per unit is equal to sales minus variable.
Ma'am, option A.
Option A is the right answer, my dear friend. So see ma, so fixed cost minus divided by contribution per unit, selling price minus variable cost. So 60,000 is your fixed expenses. Selling price is 18,000 and 18 rupees and 12 rupees. When you subtract 6 rupees, so 60,000 divided by 6, 10,000 it comes. So break-even point, rupees is equal to break-even point value is 10,000. When you multiply with the selling price per unit 18, you will get an answer of 1,80,000. Option A is your answer. Okay. Okay, try to solve this one.
%20.
Exactly. 20% is your right answer, my dear friend. So see, your marginal costing 2,400, selling price 3,000, PV ratio they are asking. So PV ratio is equal to contribution divided by sales into 100, right? We know. So contribution, we know that sales minus variable. So 3,000 minus 2,400, which has to be divided by sales 3,000 into 100. So 600 out of 330, the answer is option A, 20. Okay, try to solve this one.
None, ma'am.
Fifth question. What is the answer?
I said none.
Fixed cost. Prime cost is also known as fixed cost.
No, ma'am, period cost it's given as, ma'am.
Come again. You are not audible.
Period cost, ma'am.
Period cost is also called as time cost or non-manufacturing cost as well. So time cost means what? In that particular time, how much we are going to pay.
Like salary,
Yeah,
rent,
salary, rent and all. So what would be the answer?
fixed
It-
cost only.
Variable or fixed?
It is fixed.
You
I
can
think.
tell me once again.
I guess it is fixed only.
Okay. It depends upon the nature, my dear friends. So period cost, as I told you, it's a timing of where the cost is incurred. So in the period occurred, maybe it is occurred in the fixed time or variable. But in the examination, this question was appeared. So here the answer was fixed cost only. Okay. So why? Because in that particular time, we are going to invest some money in that. So for the particular time, it won't be changing accordingly, right? So frequently there won't be a fluctuation on it. In general aspect, it may differ, but examination point of view, they mean this only. It's a fixed cost only, the answer. Why? Because I told. Okay, we'll solve one question on PV ratio and we'll wind up. So PV ratio formula, I told you, right? Changes in the profit divided by changes in the sale into 100.
Ma'am, 20%, ma'am.
Exactly, ma'am. 20% is your answer. So here changes in the first year period, we'll get 40,000 and 20,000, 20, and here 3 lakh and 2 lakh, 1 lakh. So 20% is your answer. Good. Okay, we'll see some theoretical question and we'll wind up. Try to solve it. Profit volume ratio establish what kind of relationship?
Contribution and sales value.
Exactly, ma'am. Contribution and sales. Good. Others, next one. A break-even point total cost is equal to what kind of cost? Break-even point total cost. Very common question.
Marginal cost, ma'am.
Marginal cost is the additional cost, right?
Is it
Break-even
total
point
sales?
is a point. Very good, ma'am.
Total sales. Yeah,
Exactly.
revenue.
Break-even point is a point where it meets up the total sales. There may be no profit or no loss. Next, last question for the day. The costing method in which fixed factory overheads are added to the inventory is called as dash costing. So it's kind of a additional
Marginal costing.
Marginal costing, ma'am.
No, my dear friends. It's an absorption costing. That's why I've given here. Why? Because absorption costing means it's a fixed factory overheads which will be added up to the inventory. Okay.
Okay, one more question. Gestation period. This was also UGC NET exam question. So this, it's a time for what? Gestation.
Is it B, ma'am?
B. Exactly. It's a time taken to select the investment proposal, my dear friends. Okay. So I hope the session was useful. And what was your score, my dear friends? Who is going to be the star performer?
You will make a note of it, you said, ma'am.
I forgot to make. It's okay. All are the stars, twinkling stars. Okay, my dear friends. I hope the session was useful and cost accounting is done from my side. I'll be sharing the material and other stuff through sir. Make use of it. My best wishes to all of you, those who are going to appear in upcoming exam. And how was the session? Did you all enjoy my session? Was it useful? Was it informative?
It was all packed in one, ma'am.
So do convey to the Bala sir as well. He is my guru. So getting feedback from him is very special to me as well. Thank you all. My best wishes. One thing I'm expecting from you all is a message that, ma'am, I have cleared NET exam. I have cleared JRF, ma'am. So that makes me real happy and work on it consistently. I'll do pray for all of you, Gauri ma'am, Indu ma'am, Indra ma'am, Suganya ma'am, Nandini ma'am, and Safia ma'am, and Shalini ma'am. My best wishes for your upcoming exams. Thank you all. Any
Thank
other
you so much,
feedback?
ma'am.
Thank you.
Very
Ma'am.
informative, ma'am. Thank you so
Thank you,
much.
thank you, thank you. Thank you all. Signing off, Kausalya Venkatesh. Bye. Who is the host here now? Tirumagal ma'am. Tirumagal ma'am,
Yeah, yes, ma'am.
you are the host now. Can you please stop recording, ma'am?
Oh my God. When can I stop recording?
Or convert me as host. Yeah, thank you so much, ma'am. Thank you all. I'll stop recording. Bye.